Real quick before we get started, what you're looking at here is the S&P 500 index. It's the E-mini. And the lower indicator, I guess you can call it, is the tick chart, $TICK. And the market was kind of a little ADHD yesterday. It was up, no, it's down, no, it's up, no, it's down. Hey, wait, no, we're back up again. But when we were coming into those lows, there was a bullish divergence in the tick. And when we came back up into those highs, there was a bearish divergence in the tick. That wouldn't tell us, that we should short there. And that didn't tell us that we should buy there. But it was another confirming signal, right? Something to kind of help us out. Something that adds just a little more validity to our analysis, right? Even towards the end of the day. Ugh, that zoomed in too much. Look at the tick in that move to the downside there towards the very end of the day. All right, we got Red Book today. It's going to be a picture of consumer spending, basically. I want to start with what happened in the overnight markets. A lot of markets were closed on Monday. We didn't really notice, right? Because by the time we get up in the morning, Australia is closed, the Asian markets are closed, and it basically just leaves, the European markets. But yesterday was like the first day that they've been able to participate since last week. It was a little bit of a pop as the markets opened up last night in Globex, and then it sold off. Kind of a picture of capitulation. Now, we call it capitulation to the downside. It'd be a blow off top to the upside, but it was still right on time. And if we look at what happened in the overnight hours, we really just need these top three, because if you are using the Koifin website, which it used to be a free service, now it's semi-free. You can see that it doesn't distinguish between previous days. You got to just look at it and make sure. Otherwise, you'll be sitting there scrolling down, reading old news. So we're looking at this morning's news. The first three on the list: European stocks are down, gold prices, and then Asian stock in defensive mood. Right now, the Asian market's already closed, but when the report came out, it was 2:30 in the morning. And then the European one that came out at 7 this morning. So it's just providing a little bit of context, right? And I'm pretty comfortable using Koifin, the free version. When it was totally free, I loved this thing. I came over here every day. And now that it's only partly free, I really just look at it in the morning to kind of get an idea of the global markets. It's a good way to hit your corporate events, get to look at world economy or whatever. I'm not doing an advertisement for these guys. I'm certainly not trying to promote their business, but for years I was using this as a free product, and it still has a lot of benefits even on the free. It's got a built-in Twitter that monitors things like Market Watch, Bloomberg, and Reuters. But if you're on the free one, it's not as useful as it used to be. So we got Red Book. We had a significant move in the dollar yesterday, and that was continuing in the overnight hours. Kind of pulled back off of that, hit a Globex low, and now it's retracing again. The dollar's basically doing what the ES did yesterday, up and then down and then back up again. So we want to keep our eye on the dollar this morning. We have a Fed speaker, Charles Evans, which is funny because that's my brother's name. Fed president speaking at noon today. There is an additional auction today as well. So we come into Market Watch Tuesday, April 19. If yours is really cluttered and it looks like this and you can't find anything, hit the show all and turn everything off, and then just hit Econo Day event. You can grab that event and drag it over next to the time. That way they're just side by side, makes it nice and easy. 8:15, 8:30, 8:55, 11, and 11:30. Additional auctions are game changers in the marketplace. You absolutely want to watch those. I know they don't get the media attention of like job numbers and Redbook and all that, but they are highly significant, impactful bits of economic data that come through, right? So definitely want to make sure you're watching the clock. We are continuing that grind to the downside. The wave that I was talking about the other day is still consistent and persistent. This is what markets do, right? Literally just lower highs and lower lows, maintaining the mean. The mean would be the white line there in the middle. Keeps coming back to the mean. This is why when we're near the highs, when we have a market that rallies to the upside and new traders reach out and say, oh, hey, Sig, you think this is a good time to buy? Probably not. Right? It just reached the top of the wave. Let it pull back first. And of course, in a move like this, it was just lower lows, lower highs. When you have lower lows and lower highs, you have the very definition of trend. Nothing is calling a reversal on that. We do not yet have equal lows. We don't have any kind of bottoming pattern or reversal formation pattern. You can see back here, for an example, when we had this double bottom, we at least had something there to begin a discussion that this might be a low. We have nothing like that here yet. Nice little zoomed in view. Had to change that style yesterday. I needed that button. We'll get it put back now. Aha. All right. So just like we do every morning, we want to approach it from the idea that there are three things the market can do. It can stay inside this range. We can break to the upside, or we could break to the downside. Considering what happened yesterday, you can see that it's possible that we maintain that sideways action. That is absolutely something that we could do today. Let's go back to Market Watch for a moment. Got CPI, beige book, PMI numbers. The reason we stepped back and reevaluated is there are times where the market actually has enough foresight to look ahead at what else is coming down the pipeline. And you'll sometimes be able to recognize when everybody just kind of takes their hands off the wheel and waits, right? Like A market waiting on a catalyst is the way that I've heard it said, and I kind of like that. It it gives the right mental image of, in my mind, the picture that I happen to have from that little phrase. So we didn't really do much yesterday. If you think about like how far we went, and if you think about where we had closed on Thursday versus where we closed yesterday, not a lot of change, right? I know it seemed like we did a whole lot of running on that wheel, on the treadmill, but we didn't really get very far. So today we could just as easily maintain this running on the wheel, not getting anywhere. But it's important to realize what's happening when we do this. And we kind of got to that conclusion because of an indicator called the RSI Laguerre. Now, before this thing was invented, we didn't quite understand what the market was doing here. I mean, it's obviously it's consolidating, right? But what happens when a market consolidates? It builds energy. That's what happens when a market consolidates. It builds energy, right? So you can see through this thing, just kind of make it big for a moment. We don't need the blue line right now, just so that we don't confuse people. We just need that orange line right there. And what this orange line is doing is like it's like giving you a perspective of how much fuel is in the gas tank. Or if you've ever had one of those toys that you wind up and then you put the toy down and it does whatever it's supposed to do. This is winding up more and more energy, right? The more you turn the crank, the more energy you would give that toy. Well, the more that we stay sideways here, we're just winding this thing up more and more and more and more energy. In fact, if you look back, you know, a couple of weeks here, there's a Monday, second Monday, third Monday, 4 Mondays. We this week topped up above 62, and it was the highest reading in the last few weeks. So we've just been sitting there building up all this energy. Now, energy is not a direction. It doesn't promise you that we're going to go up or down or sideways, left and right. It's not giving any hint of directional bias. It's just telling you that this market has a lot of energy ready to go. And we could assume that before the indicator ever existed, we could assume that there was energy. But now we don't have to make that assumption. We can literally look at this thing and say, well, it's got energy. So when a market makes a move and starts to burn that energy is where it becomes important. If you think about speed, velocity, inertia, if I grab a baseball and throw it, then my force propelled that ball. It will burn its energy. And if I didn't throw it hard enough, it won't reach you. It'll hit the ground. That makes sense. If I take that same ball and drop it off the top of a building, it will pick up speed as it goes. So the ball is either moving with energy behind it because, say, I threw it, or it is moving and building up energy on the move, say, like dropping it off of a building. Well, when it comes to the markets, it's the same thing. When the market does begin to make a move, we want to be able to answer that question. Is this market moving with energy behind it, meaning there is something propelling and pushing this market? And when that, of course, begins to fade, so will the move in the market. Or is it a market that is moving and gaining energy in the move? And because of this indicator, we're also able to identify which one of those it's doing, right? So, one thing we learned is that when you get those liquidation breaks or a very fast, very extreme move in the opposite direction of whatever the market was doing, that it often is how a market starts to rebuild or gain energy. So, for an example here, where we made a move in the market, and during that move, it expended or spent or used the energy that it had. And then it continued the move, kind of a drift, chopping. And during that drift and chop, where we were failing to get new highs and failing to continue that upward momentum, the market started to rebuild energy. Now, I've done videos on this. I've taken pictures and shown the J hook signals and all of that. This is in the Discord. Just search for the fractal energy indicator or the RSI Laguerre indicator. They're the same thing. The RSI Laguerre just happens to have the RSI 2 period built into it. That would be that blue line that I turned off earlier. The gamma line or the energy line is the orange one. You'll find that in the Discord. And this is, again, not something I'm trying to promote as if you need it. You don't need it, right? Not not telling you that it's worthless, but we can visually identify that this is a market that is building up energy. It is consolidating. We know that in consolidation, markets are gaining energy. It can be used also, since it is fractal in nature, it can be used as swing trading. And that's where it has some value. So definitely keep your eye on this thing through the morning, through the range that we're talking about here. We've got our high, we've got our low. Let's game it out. Scenario one says we just maintain that range because we do not yet have our catalyst and the market is, licking its helmet and eating crayons. Okay. We'll have the same thing that we've been getting, just ranging from high to low. I find that scenario unlikely. We don't want to say it's impossible because anything's possible. But I think out of the three, that's the least anticipated out of all of them. Scenario two would be that we break to the upside. Well, we're basically flat right now. You can see that we're very close to 0% on the morning because we've rallied back up off of that low. So if we had an expectation of breaking to the upside, we could get through 44.11, which is the cog line, and it's also just above the Globex high. And then we would start challenging Thursday's levels, including Thursday's open and the cog line. That's about it. Then, of course, there is Thursday's high. Now, you might be looking at that and thinking, "Oh, that's a little extreme. Seems a long ways off." We've got an ADR of 1.5. And from our current location, if we were to make a move up to Thursday's high, that would be 1.6%. I mean, it's not perfect, but that's pretty damn close. It fits the boundaries of what a normal move in the market would be. Now, remember, markets go way beyond their norm all the time. So an ADR of 1.5 could easily be breached with a 1.6% move on the day. But we've already burned 12 hours, right? We're not starting from scratch at 6 o'clock last night. We're starting from now this morning, and we're basically flat. We know the S&P can still make that 1.5 move, but it would be a very fast move, right? It would be very significant. It would look a lot like what we had last Tuesday in a breach in a play like this, right? Nonstop, just consistent, persistent price direction with no interference from any other firm going in any other direction but down or up, right? That nobody's taking the other side. That's what it would look like. It would have to be that extreme to get us to move that far with the small amount of time remaining. But that's our upside scenario. A downside scenario, we kind of game it out the same way. First, breaching the RTH low of yesterday, then the lowest point between Thursday and Monday, right? Basically the Globex of Sunday night. And then anything beyond that, we've really got to step out into the higher time frames. I'm going to mark 4,300, but there is 4,311, right? It's the cog lines at 4,311. Those are not going to matter much to anything. It's a gravity point, not support or resistance or anything like that. Now that 4,300, it seems a little arbitrary, right? I just reached back to my left and found some price action and attached it there. That's not good enough. Don't do that. You got to validate it, right? So I'm going to draw that line and we're going to say that's the spot, but now we need to prove that's the spot. I can't just take it on faith that it looks like a good spot and it's likely to provide some sort of support to the market. We need something more than that. To find that something more would take our market over to this volume profile. Unfortunately, it's a 10-day profile, so we're not going to get anything from that. We'll have to go back even farther. We will try the 20-day. Not enough. And instead of a 30-minute, bring in the 1 hour. We didn't have to go back like that far. Whoa. All right. So it took a few adjustments to get us there. The reason that we want to adjust it is we want to make sure that we're seeing that volume back there, but without getting February, January mixed into this, right? We basically want to see the volume from just that area at that time. Give it a little more room. We can see this is the area that we're focused on. And from that, this would help if I put the spotlight on. 4,300 is what we marked. We got to look to identify, is there any validity to that marking? Well, there's a little bit of volume support around the cog line, 4320, 4312, right? The low to mid 4,300 area, and then the 4,300 itself. Now we marked that spot without first coming in here and looking. And if you come in and look, what we see is there's actually more volume underneath 4,300. So instead of marking 43, we would be better off marking something like 4260, right? This is why just drawing that line at a previous price area isn't good enough. We've got to go back and look and see, well, what else do we have? So if price was to breach and make a move to the downside, there's some volume support around that 4320 area. Then there's the value area low, 4270, and below that, some price volume that is pretty ugly, but it's thick, significant. So it should slow anything down. It would take a monster, massive amount of push to be able to breach and get below that. We're talking 4.5%, 5% moves, right? So if we back it up to, say, a 1.5% move, that brings us down into the value area low. Really, there's a 1.3% move and it's 43.25. It's right there into that volume. That volume ties in with the last little hurrah play from 310 high a day. So that's the one we want. That way. Now with the econ on deck today, most of the time we talk about the econ from an idea of good or bad. But a lot of times the econ that comes out is muddied. It's kind of gray. It's got some good in it and some bad in it, and we don't get the move that we're looking for. Right? They say, "Oh, it's supposed to be a highly anticipated, highly impactful economic event," and then it comes out and it's like crickets chirping and nothing, silence. We don't really see a move in the market. So there's a couple of reasons for that. Sometimes the market calls it and actually gets it right. They say it's going to be good or it's going to be bad. They price it in ahead of time. The news comes out, it does what it was supposed to, and well, the market had already priced it in. But other times it's because the news is so muddy, they got to call the geek squad and say, okay, nerds, tell us what to do with this stuff. We got some positive, we got some negative. What are we going to do going forward? And then they got to wait for the nerds to crunch the numbers. So as we get Redbook today, if you don't see an immediate response to the numbers, don't assume or imagine that we're done with Redbook for the day. Keep your eye on the headlines, keep your eye on the news, and look to see if the analysts come out with more later in the day about what they're going to do with it. Same situation in the Nasdaq. We have a range bound market. Three scenarios. We can keep the range, break the upside, break the downside. I still say it's very unlikely we're going to maintain the range. It's plausible, it's possible. I don't think that that's the highest, what do they call it, base case. That's not my base case, right? So it's on the table. I don't believe it. From that, what do we got left? Top side, bottom side break. Well, a top side break would have us flirting with yesterday's pivot points right around 14,100. Then beyond that, the open of yesterday, which would be 14,200 ish, 14,2 and a quarter, and then the highest point of yesterday. Now, since the open and the intraday high are so close together, I'm not going to mark them both. If we actually traveled up into that area from Thursday, I don't know why I said yesterday, into Thursday's levels, then it would be worth my time to mark both the intraday high and the open. But until we get there, I'm only going to mark the open. Another one worth keeping your eye on, because we just keep passing through it, is the close from Thursday or the open of Sunday night. Now you can see we've been passing through it just consistently, and it doesn't seem to have any effect on the market. You still want to know where that is. It's not just an RTH open, high, low close. It's also the close of the week. So it's a weekly pivot point as well. Weekly high, weekly low, and weekly close are just as valuable. Definitely want to keep your eye on it and where we are on it. Are we above it or below it? Has some validity to it. Just like the weekly pivot. Are we above the weekly pivot or below the weekly pivot? So that gives us our upside move. Just focus on the downside move. First, breaking through our Globex low, then the low of yesterday, then the lowest point, 13,700 from Sunday night. Just that move alone would put us at around 1.5% to the downside from our current location. We got an ADR of 2.3, so that we know that we could make that move plus some, right? We've already got a dime. So if we were to add 2, that would put us at around 13,6 and a quarter. Yeah, if we get that close to the roundy, we're very likely going to go to the roundy. So we'll call it at 13,600. There's nothing saying that we're going down there today, right? It would take, again, significant news to drive us to the edges of the ADR. The ADR has been declining every single day for weeks now. All right, so we're looking at the 10-day, 30-minute again, putting this thing back to where it was. You can see that we're inside the volume profile. We're inside the box. And it's important to get my lines off of there so that we can see where the POC is at, the point of control. The greatest amount of volume is where the point of control is at. That's Tesla. Let's put it back on Nasdaq. There's the volume profile box. We're outside the box, very close to being back inside the box, but we got a lot of volume over our head. And there's volume resistance at 14,070. And the point of control is a long ways off. It's near the top of that range. Now think that through for a minute. If this is a 10-day profile and it's reading all the way back from a couple of Mondays ago, and the significant amount of volume is at 14,500, and we're well below that level, and in fact, we haven't been back to that level in over a week. We still have not built up enough volume at these lower levels to match the amount of volume or transactions that happened when we were at 14,500. That's just quite a bit. That It was a short week last week, though, right? We didn't have Friday, so we're missing some volume from there. In blue, we see transactions by time, right? We got volume by time and volume by price. Well, volume by time, TPO, puts the point of control a lot closer to where we are right now, 14,225, as opposed to the POC on the volume profile, which is 14,475. Also, the value area high and low is much more compressed on the time version. So we got a lot more aggregate time spent below 4,500 than we do of aggregate time spent above 4,500, 14,500, excuse me. So one of the things about volume profile that's useful is to mark yesterday's levels like the point of control, the value area high, and the value area low, and then plot them forward into today's price action. And when you do that, there's the expectation that if or when price comes back into those levels, that it responds at those levels. Well, we bounced off of that POC before getting another run at it and breaking through it to the other side. But it didn't stick. We came back above the POC. Still, there was the first touch, right? It did slow it down. There was a reaction in the market at that point of control. And that's basically what we're looking for, right? When markets are making these moves, what's our expectation to the downside? What's our expectation to the upside? Are we, quote, going to hit something? Always worth taking a look at the daily and the weekly and the monthly charts. I don't live there, don't want to spend a significant amount of time there. But if you never go out to the daily, weekly, monthly, and there was something to see, you're not going to see it because you never go out there. We are underneath the anchored VWAP. That anchor is from the first of the year. Is basically sideways, and we don't hold a lot of validity to any sideways average. It doesn't matter if it's a moving average or a VWAP or anything else. It's still a sideways average, but you can see that it's been providing a bit of a ceiling, right? We've been unable to breach and get back above that VWAP. Also significant to realize, where are we at within the expected move of the week? We're above where we ended the week on Thursday, but we're basically nowhere, right? We haven't gone anywhere. We haven't done anything. It kind of builds the case for the argument that this is a market waiting on a catalyst. I did put out a video yesterday. I've gone through during live streams and I've talked about what we watch and why. But I didn't really talk about how we watch what we watch or what to do with it. And during a coaching session yesterday that I accidentally did not record, I went back and rehashed the things that I had talked about during the coaching session. And I figured, it was good enough that I should just go ahead and share it with everybody and posted that into the chat. So you can find that in the large caps chat room. It was mainly a discussion about tick, advancing issues, looking at the dollar, looking at the bonds. And the dollar and the bonds right now have been really impactful. They've been significant to our discussion and even our recognition of trade opportunities. Say, for an example, when the S&P was coming back up into that topping pattern. Well, if you were to look at what was going on with the dollar during that time frame, and even through the bottom down here when we V bottomed and then revisited that bottom later on, what was going on with the dollar? It's worth watching the video. It'll kind of explain in a little bit of detail how you can use these through the day to kind of help provide some context before you take a trade. It's not telling you get in now, right? That's not what it's about. It's if you already had a trade that you're looking to take, it's going to provide just a little bit more context, right, about what's going on. The dollar and the bonds have been severely impactful in our market recently, right? They've been the ones that we've had to really watch close. The same thing with oil, right? We've been seeing just these exaggerated sweeping moves in oil that has had significant impact in our market. Now, this grid that I'm looking at, this is not the standard grid that we've been using for the last couple of years. It's an adjusted grid that we've been using since the Russia-Ukraine situation came along, right? And we swapped out the Russell and the Dow to add gold and Bitcoin. So the gold is a little bit about the inflation situation. They've been trading into gold to kind of protect against or it's considered a hedge on inflation. So when we hear me say things like the hedge trade, this isn't a hedge against the market going lower. It's a hedge against inflation. With the Bitcoin, it's a really new product in the grand scheme of things when you really think about how long the market itself has been around. And then looking at it from the point of view that only until recently it wasn't really impactful. In the last year or two, it's become significantly impactful. And right now, we've got a country who's basically blackballed. Nobody wants to do business with their money. So you can't use the ruble. They've been told, the citizens of Russia are been told, you can't convert your ruble into something else. So they can't turn it into the dollar because we're trying to sanction everybody, right? So they don't want to be able to see Russian dollars being spent anywhere. Well, where do you go? Go to a digital asset that you can use all around the world, Bitcoin. And we've seen the response in that too, right? When the news came out, when sanctions came out about exchange rates and the FX markets, we've seen the Bitcoin reacting to that. It provides just a little bit more context, right? If the best indicator is price action, then looking at price action in multiple markets provides a glimpse and a view and a perspective of all of the marketplace. When you put this grid together with the other grid that I tend to watch through the day, you've basically got a 360-degree view of what's going on in the entire market. Small caps, large caps, technology, the sectors, the advancing and declining issues, stocks, bonds, futures, in the volatility, the dollar, and you got it all. You got everything. Commodities, everything. And the way the market works is everything's connected, right? The S&P futures don't go up on their own. A lot of times they set the mood. The algos will trade directly into the futures and the rest of the market responds. But a lot of times it's not that way. The algos are hammering the basket of stocks that make up those futures, right? Because the futures is a representation of the S&P 500. It'll hit some of those big name companies in the S&P 500, which moves the futures markets. So we don't always know which one to watch. We don't always know which one is going to be the more important one today. But if you watch that video, that I talked about. I explain how you can watch these and use them to your advantage, looking at them as either a leading indicator or not, or a confirming indicator or not through the day, right? And it can shift. We can run strong with the dollar for 2 hours and then decouple the dollar completely and swap right over to bonds. There's no promise or guarantee that either one of these or any of these is going to be significant or impactful or useful. But we have to look for those signals, validate when the signals are there, and then use them until we decouple from those signals and they're no longer valid and useful. It may seem complicated, but guarantee if you do it for a little while, you'll get to the point where it's not complicated anymore. It's in the large caps chat room. So if you were just to go to the large caps chat room and scroll up a little bit, you should see that I posted a video yesterday at 5 o'clock. All right, so we're looking at the legacy sectors here. This is just like the old school legacy S&P sectors. This is a pre-made watch list straight off of Thinkorswim. I didn't have to make it. You don't have to make it. Just go to public, and since they're alphabetized, go to S&P sector indexes. You'll get this watch list. And if you look at the relative strength for the last 2 months, 42 days in the market, 2 months, the consistent theme has been energy and materials. We've had a relative strength for all of those 42 days or for the last 2 months. Something with a little bit of weakness but continues to be strong. And in fact, you could argue, that it started out good, kind of sagged and faded for a while and came back with a rally. Consumer discretionary. Industrials started from behind, rallied back up to a highs, and now is starting to pull back a little bit. We're talking about the relative strength, right? Comparing it to the rest of the marketplace. Basically putting a side by side between this and the S&P and saying who's doing better, this or the S&P. And then the healthcare sector, which was doing reasonably well and just kind of jumped off the cliff. So this morning in the pre-market, we got red across the screen, all of the sectors. But we're going to go to Trendspider to look at these because Thinkorswim really doesn't do a good job of change in percent in the pre-market. This is a modified little homemade perspective, but we can't trust it. The watch list columns don't always do what they're supposed to do. And this may say that we're flat and we haven't gone anywhere. But what you'll often find is, that it's not quite accurate. So it's a good gauge, kind of a starting point, but want to find a different tool for the change in percent in pre-market. So that's why we use Trendspider or TradingView or Fidelity's got a new pre-market tool that's pretty useful. Anything more than Thinkorswim, because Thinkorswim just doesn't do change percent in the pre-market very well. Kind of drops the ball on that. But before we go over to any of those other products, I want to look at the FANGs. This is something that I've gotten in the habit of doing more and more lately. Watching these as a group, going in the evening and evaluating these 8 names. What you'll notice is most of the time the 8 names are lining up with each other. There was a small period of time where Amazon and Tesla were kind of decoupled from the crowd a little bit. But other than that, on a day-to-day basis, you want to give it that close-in evaluation, looking at what's going on and what happened yesterday, right? So, for an example, Apple had that gapped down market and then it rallied back up. But if you recognize what happened, it may be a green candle, it may have rallied back up, but it still closed lower than where it had closed on Thursday. So, you know, a nice bullish recovery, but still a down day. Whereas Facebook, on the other hand, basically opened up sideways from where it had closed on Thursday to where it opened yesterday, went up, went down, inside day breakout, all of that, then came back inside and closed within Thursday's levels. Nvidia as well closed within Thursday's levels. Same with Google. And look at how wound up Tesla is. There's been a lot of angst and a lot of news and a lot of eyes on Tesla. It was supposed to be very bearish, or at least the news was seeming to be bearish, and yet we're still sitting inside of 413 with last Wednesday's price action. This is IX10 now at this point, and we're just winding up more and more energy. Multiple days in a row of compression builds and builds and builds until we finally break out. Now, doing this kind of deep dive on the sectors, if you were to go to, the XLF, XLK, and break those names down just like this, putting it on something like a daily chart, zoomed in view. The zoomed in view is important. When we're using a 6-month or a 1-year chart, it's because we're looking at a big enough set of data to recognize what the primary trend is, right? The primary and secondary trends. But on a day-to-day basis, if I'm going to be day trading or just getting a trade for a day or two, maybe holding it for Friday's expiration, then it's more the intermediate trend that I'm worried about. It's the more immediate price action. I don't need a 1-year chart. I need to know what's been going on in the last 2 days. I want a zoomed in perspective of the market on that daily time frame. That's where a grid like this becomes useful. Right now, I've shared all of the grids. They're in the Bullish Bears Discord, so that all you have to do is go in and pick something like the XLK and you get your chart. Yeah, once you have the chart, you can take your own time to go in and set all of them to the daily time frame that you want. So looking at what was going on in the aggregate names that we use, because on Thinkorswim you can like make your own little ETF. This ETF has both Google's, Nvidia, Microsoft, Tesla, Amazon, and Apple. It was a nice little bellwether, and it has been day after day for quite a while now. Right? Just use a plus sign, and you can do this with anything. You can do this with financial names. You can do it with the futures. I've done it with the futures. I didn't keep it, but you can pretty much put whatever name you want in there. So when we're looking at this, we're looking at the aggregate of all of those FANG names combined, and we're looking for bullish and bearish sentiment. Uh, it just provides a little bit of that context, right? Because if those 8 names turn bearish and start weighing down the market, it won't matter how many other sectors we have that are doing good, how many other names that are doing good. If these 8 are doing bad, the market's going to do bad. If these 8 are doing good, then the market's going to do good. All right, sectors. So energy's down this morning. It's not much of a surprise after the move that we had. So you can see with the energy, we kind of closed in the upper portion of the day, gapped down now in the overnight hours. Emerging markets, same thing, kind of closed in the upper portion of the day, gapped down. We use emerging markets as a scope and bias and perspective of global dollars at risk. SPY is relatively flat. Now, small caps are kind of trying to pick up off of those lows. They seem to be doing a lot better this morning than the S&P. Financials are up more than 0.25%, but that's not our benchmark, right? We want at least 0.5% before we consider something bullish or bearish. 0.25% doesn't get us there, so we want to see more out of the financials. The devil's metal, close to 0.5%. That would be silver. And marijuana up 1.8% this morning. But looking at it, it looks like it was more up from yesterday than it was anything else. And if we zoom into this a little bit, that really doesn't look like it's up. Maybe it just hasn't updated, right? Always check your platform. Don't just trust it or assume that it's right. Everything can be wrong sometimes. But those S&P sectors they don't cover the more modern things that we need to cover, right? So we come in and bring in crypto individually. This is our own homemade little ETF on crypto, and most of the names in the list are doing really good. Now, if you realize what's we're looking at here, it's not crypto names, right? These aren't like Bitcoin and things like that. These are companies that are heavily invested in the blockchain and or own a lot of crypto. So those are doing good this morning. We want to look at chips or semis, as I heard them call frequently. Again, those are looking really good. We got a few odd names that stand out to the downside, but otherwise they're looking, reasonably decent. We need to see them more than 0.5%, and most of these green names here are not hitting that benchmark. GFS is above the 0.5%, but not by much, and that's not saying very much for a market like this either. Taking a look at the EV market, it's kind of a mixed bag. We got some names doing good and some names doing bad. When I come in and look at this, I always take a look at the legacy names. I gravitate to those, Ford and GM, because at the end of the day, mass producing a vehicle like Ford and GM does, as opposed to the high quality one vehicle at a time concept from things like Ride, XPEV, Lucid, Rivian. You want to be able to make that distinction. And the pot stocks. So the pot stocks are looking pretty good this morning. They've seeing a lot of liquidity. A significant number of names are up more than that 0.5% benchmark. But there are some weakness in there, especially say on the real estate name, that 22nd century. They cater or specialize in finding real estate for the marijuana companies. They're down this morning. So it seems like the play is going to be the same play that it has been: energy and finance, energy and finance. The two watch lists down at the bottom is a collection of all of the weekly options. On a day like this where you can't lean into the sectors, you're going to have to lean into your own watch lists, right? On a day like this, running your own watch list is going to be how you find your opportunities. And you can see that there are plenty of names this morning that are viable for an opportunity. I wouldn't lean into the sectors today. I don't think the sectors are going to provide any input or opportunity, at least and unless we can get that breakout in the S&P and the Nasdaq. Then you could see a little bit of help or assistance from the sectors. So until then, we just want to run our own watch lists, look for our opportunities through there. Keep your eye on the clock, guys. We got the Fed speaking at noon, and we got some econ coming through the day. That's what I got for you. Be careful, be safe. I'll see y'all tomorrow.